should I invest in the stock market where maybe I lose a lot of money?
To be focused on crushing demand.
So you got a lot of selling, but not sure who the buyers are.
He doesn't seem to be concerned about the stock markets at all.
Is the market right that Powell is a pivoter? He'll eventually cave, then risk assets go to the moon, or...
All right, Joseph, thanks for joining me today. The Fed guy, we certainly have a lot to talk about in the world of central bank policy, so I'm excited for this.
Well, thanks so much for inviting me, Mark. I'm excited to be here. And also, I see that you've published your new book. Very excited to see that's well-reviewed, and I've ordered it, and I can't wait to read it myself.
Oh, thanks. Thank you. I appreciate that. Yeah, you saw it when I was just kind of throwing around the copies.
Yeah. I saw it's on Amazon now, too, right?
Yep.
We're very well-reviewed, 5 stars, so can't wait.
Yeah, thank you. So thanks for bringing that up. Shameless plug. He's talking about the book, The Uncommunist Manifesto. If you haven't got your copy, go to Amazon, The Uncommunist Manifesto. It's a short read. It's about an hour read. Everybody should read it, in my opinion. Communism seems like an old word, but it's just rebranded today. Instead of abolition of private property, it's you'll own nothing and be happy.
Exactly.
So let's dive right in, Joseph, because I got a lot to cover, and we'll see how much we can get through. Sometimes I get a little too ambitious here, but look, the markets are crashing, real estate's getting marked down, stocks are going down, currency wars are erupting all around the world. The Bank of England just broke again. Stuff's going haywire. So I want to dig through all of this, but let's start with myth or fact. Last night on Twitter, you and I were kind of engaged in this thing, and myth or fact. Does the liquidity drying up cause the markets to crash? Now, I know there's a lot of nuance here. Jeff Snyder, I had him on 2 months ago, maybe a month or two ago, and he said that, and I think actually you were at the same event, at George Gammon's event where he was at, and he says the Fed has no control. The euro market's so big. The reason why the markets crash is there's a dollar shortage. So is the shortage of dollars myth or fact?
Yeah, so that's a really interesting question. So how do you measure a shortage of dollars? So I'll tell you how I look at this, and I'll address how I think some other people might be looking at this. So shortage of dollars, we usually think of that as someone wanting to borrow dollars but not able to access it. And the way this is measured is something called the FX swap basis, which is the premium that a foreigner has to pay when they borrow dollars in the market. So when we have major market disruptions, for example, Lehman going down, or what we saw during the March 2020 pandemic panic, we saw the FX swap basis widen significantly. What that means is that a lot of people who are trying to borrow dollars just can't get their dollars at market prices, and so they're having to borrow at extremely high premiums. That, in my view, is what a shortage looks like, when you have money to pay and you just can't get it. Now, the way that
you can't get it, meaning it costs more than you're able to pay for it.
So there's a market price for dollars, and there's also how much extra premium you have to get. You have to pay for it to get those dollars. So that's kind of how it's measured. And the market price is usually set by the Fed, because the Fed controls short-term interest rates. So if you have to pay a whole lot more than the market rate that's roughly set by the Fed, I think of that as there's a problem with the supply of dollars.
Okay.
There could be, as people say, a shortage.
Okay.
And the way that this is fixed is the Fed steps in, and they're with a tool called the FX swap facility, where they're basically lending unlimited dollars to foreign central banks, who then take those dollars and lend it to their own banks, who then take those dollars and lend it to, let's say, a corporation or something like that. And so when the Fed opens up this FX swap facility, what we see is that immediately the premium to borrow dollars in the offshore markets disappears or becomes very small. We see that consistently when the FX swap facility opened up in during Lehman's collapse during the Great Financial Crisis and in March 2020. And the thing is, the FX swap facility is actually still open. The Fed never took it away. So it's operating on full force, and there's very, very little participation in it. And the reason being is that the premium premium cost to borrow dollars right now is not particularly elevated. So that to me suggests that there's no shortage of dollars. Everyone who wants to borrow dollars at the market price can get dollars. Now, that's the price to borrow dollars. Now, I think a lot of people also point to the US dollar strengthening, and we see what's happening, right? Dollar to euro, euro's below parity. We see the Japanese currency basically imploding, and so that's making the dollar very strong. Now, I don't think of a strong appreciating dollar as a dollar shortage because there are actually very good fundamental reasons for that. The first, of course, is that the Fed's hiking rates aggressively. If you're investing dollars in a money market fund, you're getting 3%, and maybe you'll get 4% soon. That's much higher than you can get in Japan or Europe. And also, there's a lot of geopolitical factors that are encouraging investors to move their money from, let's say, away from the war zone in Europe, because Europe is in a war zone right now, to the U.S. So the dollar's appreciating because it's becoming more valuable. I think of it as, let's say I have a house and I add a pool to it. The price of my house goes higher, not because there's a shortage, but because I've made it more valuable. And higher rates make a currency more valuable. Honestly, that's actually kind of part of the plan of what the Fed is trying to do. If you listen to Chair Powell discuss his strategy to get inflation down, one of the pillars is to have a strong dollar. So it's proceeding as he wishes it to be.
Now, when I look back through the long lens of history, we can see times where we, used barley for money, then we used metals, and then in the 1500s, Spain found a huge silver mine in Peru, and then that increased the liquidity of money supply in the world, which caused inflation and massive acceleration, and then the silver mine ran out, and then things start contracting. And so we can kind of see throughout history, every time you increase the money supply, you get booms and you get inflation, and then when the money supply starts running out, then you get contraction. Now, the Fed has obviously said that, so they did, there was a long list of QE that was happening, right? So they were easing the money supply. Now they're going through tightening. And if I think about it just in super basic terms, and maybe that throws me off, but if because we're in a debt-based system, money's created through debt. So if I lower the cost of borrowing, more people borrow, more money's created. And you were talking about that, right? The cost of the dollars to borrow. If I increase the interest rate, then less money is created, less people are borrowing. So doesn't that, I guess it's not a shortage of dollars, but it's a shortage of ability to access the dollars because now the cost of those dollars is prohibitive to what I could spend on it.
Well, that's true, but there are other factors as well. So if I raise an interest rate, you're exactly right. There's less of a demand for dollars. But what if I'm willing to pay the market price for interest, but I still can't get any dollars? That becomes more of an accessibility functioning problem of the market.
Right. So you're saying it's a shortage. I'm not able to get them when I want them. I'm thinking
even when you're paying market prices.
Right. I'm thinking a shortage of just there's not as much money in the system because less people are creating it through debt. So it's not that I can't get it, it's that I can't get it at the price I need it. And so we just don't have the new creation amount of money has decreased.
Well, because the Fed is willing to lend infinite amounts of money at the market price, if you're willing to pay the market price, you can get all the dollars you need. The shortage, in my view, how I look at it, occurs when even if you're willing to pay the market price as set roughly by the Fed, you can't get it. That's what. Yeah. So you're definitely right, though. So the whole point of raising interest rates, in a sense, is to decrease the credit creation and thus the supply of money. But there's something really interesting happening with the world now. When we have a world where it's largely based on private actors, this works because, for example, if the interest rate is higher and let's say I want to buy a house, get a mortgage, I'm less willing to do that because I'm sensitive to interest rates. So using interest rates as a tool to control inflation works when most of the economy is based on the private sector. But what if you have a world where most of the economy is actually the public sector? Now, we all know that Congress is never going to go into a spending plan and say how we're going to pay for it. Interest rates too high. That's never a question. So interest rates don't matter to public spending. So if you have an economy that's becoming more dominated by the public sector, that tool of slowing down credit creation through interest rates becomes less effective.
That's a good point, because they don't have the same constraints that the private sector has.
Exactly. That's something that I think is becoming more obvious now, when on the one hand the Fed is trying to slow down the economy by raising rates. On the other hand, Joe Biden just announces he'll forgive, hundreds of billions of dollars in student loans. So they're pushing against each other in a way.
Yeah, and now with the central banks needing to buy money to prop up their bonds, which we'll get to that in a little bit.
Yes, that's a really good topic we'll talk about later.
Yeah, so I want to stick on this. So increasing the money supply and decreasing the money supply. So you recently had this article that came out on Barron's. We'll put a link to it down in the description below. And you were saying how, for 2 years, because of quantitative easing, it doubled the central bank's balance sheet to $9 trillion, 40% of the nation's gross domestic product, which helped fuel significant gains. That's what you said. And the QE, the easing, the increase in the money supply, put downward pressure on interest rates. So the converse of what you're saying. So it pushed the borrowing costs down because there was so much liquidity, right? Which increased liquidity in the system. So there's that. And now the opposite of that is happening. So now they're tightening. And so now they're reducing the security holdings by 95 billion per month. So it's the opposite of QE, which would then put upward pressure on interest rates and decrease liquidity in the financial system, which is what we're seeing.
Exactly right. And we see the effects kind of obviously, right? QE makes the stock market go higher. You reverse QE, stock market seems to be going lower. So there's a lot of factors at play, but I think that's one of them. One way I think that I look at the money supply, since I think it seems like you focus on this as well, is that I would also note that when you're looking at money supply, you could broaden your definition of money to include not just, let's say, M2, but you could also look at treasury securities. For example, if, let's say, I am someone working at a company, every week I get, let's say, a wire transfer from my company into my bank account. Let's say $1,000. If instead of receiving $100,000 in my bank account, I got 1,000 in treasury securities instead, will that really make a difference to me? And I don't think so. I mean, in many ways, just like a $100 bill is money, so $100 in treasury securities is also a form of money. So when the Fed is going out and doing QE by buying treasury securities, a lot of times, rather than say it's increasing the money supply, I find it useful to think that it's just changing the type of money people have. So going back to the example that we just mentioned, instead of being paid maybe $1,000 in deposits in a bank, maybe I'm getting instead of being paid $1,000 in treasury securities, I'm getting $1,000 in a bank. The difference being that treasury securities have a yield, pay interest, but what I have in the bank doesn't. So when the Fed is doing QE on a large basis, it's taking away risk-free assets that offer interest to people and replacing them with deposits at a bank, or basically money that doesn't pay interest. And that forces a lot of people to go and look for more risk or higher interest returns. And that's what kind of forces the whole QE risk on, in my view. So one day I had a treasury paying, let's say, 2%. Today I have a bank deposit paying nothing, so maybe I go buy Apple bonds or Apple stock or something like that. Now QT does the opposite of that. Now interest rates go higher, there are more treasury securities for me to purchase, and so maybe instead of buying Apple, I go and I buy a 2-year treasury that's yielding 4%. So that's kind of how it works in my view. You have this huge reshuffling of people going out of risk assets to just, parking it in that treasury security or the money market fund for a higher return. There's less need to take risk.
The risk-free rate, right?
Yes, it's getting higher. It's going to be 4% by the end of the year. A lot of people are going to have to look at that and say, should I invest in the stock market where maybe I lose a lot of money, or maybe I can just put this at the risk-free rate and earn 4% with no risk at all.
And even though the 4% is still still a negative real return,
Exactly.
at
yeah.
least it's known at least it's known what my risk is, as opposed to unknown. Could the stock market drop another 50%? We don't know.
Exactly. So that's a big headwind to risk assets, and we see that already,
Yeah.
as you suggest.
Yeah. Now, it sounds like, so just to finish, nail this point home on the shortage of dollars. You call that your definition of shortage of dollars when people want them but can't really get them. I'm looking at as just the total amount of dollars being created going up or down. So when the total amount of dollars being created goes up, we have more liquidity. We see assets go up. When the total amount of dollars goes down, then we see assets go down. Not that people can't get them, but there's just less of them because they're not as cheap as they were before. Right.
So you have more alternatives
Right.
when you do QT. You have higher interest rates, right? There's less demand for assets in general when you have safer alternatives, like we just talked about.
Well, and if I was going to borrow short at 0.5% and then go long at 2 or 3%, right? I may take those dollars because I can make that 2-3% spread. But when those numbers change, I'm not gonna borrow the dollars because now that deal is not available to me anymore, right?
Yes, the cost of carry goes higher, so there's going to be less leverage, less borrowing, and less borrowing obviously decreases the amount of money in the system.
Mm-hmm. Now, so if we keep moving on to that, Chairman Powell. He's been pretty strong with his wording. I think he got hammered a little bit a couple months ago. At the end of the meeting, he got a little dovish, and they had to kind of backtrack that. In the last two meetings, he's been more harsh, more hawkish, I guess. He says that they'll stay at it until it is done, right? So like stay at what, right? I guess continue tightening until what? Until inflation comes down. He doesn't seem to be concerned about the stock markets at all. Really just focused on inflation, it seems like. You hear a lot of talk about a pivot, but again, he doesn't care about the stock market. And ultimately, if you look at it, maybe the stock market hasn't even been hammered that bad as of now. But what we are seeing is the bond market, right? So there's a lot of volatility coming there. The VIX is spiking, credit default swaps. Is that where you think the focus is, like the liquidity in the bond market?
Exactly. That's where I think the big risk is. So when you're doing so I imagine many of the viewers here are familiar with how Bitcoin trades, right? So if you have, for example, in Bitcoin, when you look at the market, if you have a whale come in and unload a whole bunch of Bitcoin, prices are going to drop a lot, right? That's a liquidity issue.
Right.
If you go and you sell a whole bunch of Bitcoin,
supply and demand, right? Supply and demand.
Exactly. It's not just now the treasury market is just like Bitcoin in that sense. There's just supply and demand. If you sell a lot of treasuries, you're going to get unstable prices, and that's exactly what's going on right now. So QT at a high level means that the market is going to have to absorb a lot more treasury securities. Now, how much more? A lot more. This year, it looks like the total issuance so issuance including QT that the market will have to absorb is about 1.5 trillion. Now, before the pandemic, the market was absorbing about 500 billion a year. So it's going to have to absorb 1.5 trillion this year and the next, and going forward, because of our deficit, it's going to be at least $1 trillion a year forever. So that's a lot of supply into the market. And at the same time, the demand in the market is not that strong. So after the pandemic, the Fed was basically the major buyer of treasury securities, and the Fed is going away right now. So you're going to have this huge supply and demand mismatch, which we kind of see manifesting in the treasury market. You see sometimes the 10-year goes up 20 basis points a day. That's pretty unstable, and we've trended steadily higher over the past few months because we have to find these new marginal buyers to absorb all that supply. And I don't know who that is. Like you mentioned, inflation is high, and who wants to buy a 10-year treasury security at 4%? You can get the same thing in a money market account.
Yeah.
So, and that's what happened on the Bank of England as well, which I'm sure we'll get into.
Yeah. So If we stick with what you're saying, so just supply and demand, it's the most
Yeah.
simple thing. You can take these super complex subjects and just break them down to just the equilibrium of supply and demand. And so back to just where we started with the money supply, when money's cheap, there's more demand for it, right? And so back to the supply of treasuries. So if the government is going to need to issue more, they already are. You said it's gone up from
Yes.
they're having to absorb 500 million. Now it's up to 1.5 trillion.
Yep, 500 billion to trillion. Yep.
If we look at the Fed seems to be focused on crushing demand, right? That's what they've said. They believe that if they can crush the demand side, then people will spend less money and maybe they'll bring inflation down. The problem to me seems that it's asset prices that are getting hammered first.
Yep.
If asset prices come down, then there's no cap gains, there's no IRA distributions. We already have a huge balance problem, right? We're already running a deficit to the point that you're making. And so if we see asset prices come down, then we don't see, like I said, the cap gains. We don't see that. We also see the reverse wealth effect, so people spend less. So total tax receipts are just going to plummet, most likely. 70% of the taxes come from the top 10% of earners, which most likely make the majority of their income from cap gains, distributions, and things like that. That's 70% of tax receipts come from that. And so we could see a massive hit. We could see this from 500 million to 1.5 trillion or even more. We could see this deficit grow by levels that maybe they're not even anticipating. Or do you think that's too apocalyptic?
I think you're exactly right. That is the big picture. How are we going to pay for all these things? Our deficit is, there's a forecast put out by the government based on law, on the books. It's forecast to basically be at least $1 trillion a year forever. And that's just what's on the books. Eventually, I'm sure they're going to give more free stuff. So that is the problem. It does seem apocalyptic. And it seems like, I think Stanley Druckenmiller recently made a similar point just last week, I think. So it's a big problem. So the way that I look at it is that it's never a financing problem, because if you are the U.S. government, you have a printing press. You can always pay for everything. Interest rates, debt, everything. Just print it, have the Fed print it and pay for it. Super easy. But that has consequences as well. The consequences are not that I can't make my interest rate payments, I always will be, but that if I print all this money, then I'll have inflation. So that is ultimately the constraint that the government has, and we're seeing that right now. So in 2020, government just created a couple $1 trillion, gave it away in stimmy checks and PPP loans, and we had massive inflation. And not just us, but people all around the Western world did something similar.
Yeah, even worse.
Even worse. So that is the problem that we face right now. We're going to have, it seems like we're on a very big inflationary trajectory. We're going to be able to afford all these payments. It's just that it'll be inflationary.
Mm-hmm.
And it's the only way to stop this would be to convince Congress to not spend so much. And that's just not going to happen.
No, now we're spending to reduce inflation. The Inflation Reduction Act, right?
That's how it works, right?
Yeah, if we spend all this money, we'll actually have it. I think it's pretty easy. You don't have to be the Fed guy or a Fed insider or economist. I mean, you could just ask the average person on the street, like, do you think the government's going to spend less money or more money in the future, right? And unfortunately, as these things continue to evolve, I mean, we're already seeing it. Specifically, we're seeing it more in other countries, but with UBI, things like that, assistance in California, they want to give tax rebates to help offset the rising cost of fuel. Obviously, in the UK, they have a big deal with that, where they're trying to offset energy prices, and so it looks like more social spending is coming. Obviously, there's this green transition that they're pushing, and so it looks like spending is going to go up. It looks like tax receipts are going to come down. And I think both of those are going to happen at the same time. Now, with inflation, maybe it kind of looks like GDP is going up inflation, but in real economic output, there's nothing there. And then at the same time, if that's not already bad enough, at the same time, we have, because of the currency wars that are going on, so we're pushing inflation to these other countries. Now we're getting into these currency wars, and it looks like we're seeing Japan, we're seeing China, in order to shore up their currencies, they're dumping dollars to buy their currencies in the open market to keep them somewhat propped up, which is even more selling on the treasuries, right?
Exactly, exactly. That's a special thing about the dollar. Everyone kind of has to manage their currency with respect to it because it is the world's reserve currency, and the way they do that is they keep a rainy day fund of dollars in case their own currency gets too weak. Then they use the rainy day fund to basically shore up their own currency. So they would sell dollars and buy their own currency, but that rainy day fund, which is usually held in the form of treasuries. So they'll sell treasuries, like you suggested, and that's even worse for the treasury market. So you got a lot of selling, but not sure who the buyers are going to be.
Which just exaggerates the problem.
Absolutely. So there is some tail risk here for that you could have a very uncontrollable sell-off in the treasury market. But it's a tail risk. It doesn't necessarily mean it will happen.
It seems like the Fed, and you know better, you tell me, but it seems like the Fed, one, and I think you and I have had this discussion before, where the Fed doesn't want to surprise anybody. So they try to really broadcast far in advance what they're going to do. They announced in November that they were going to start raising rates. We didn't see them raise rates until January. And so they tell us this, that they're going to do these things. But it also seems like they get really dug into their position and feel like maybe they have to hold with this. So like Jerome Powell was saying, we can't get inflation. We're not thinking about raising rates. Then he said, we're going to let it run hot. And then we got it, right? And then it was like, well, it's transitory. And it seems to be, pretty much every pundit and economist out there says that they waited way too long. They should have started raising sooner. But maybe they were dug into that position of not thinking about. They weren't going to raise rates till 2024, I think it was. And so maybe they were dug in and finally said, okay, fine, we have to pivot. And what I'm afraid, so one, comment on that. But then two, if that's the case, if there's some truth to that, then maybe I'm also worried that they're also dug in that they're going to raise rates through the end of next year. And like even if these treasuries start spiking, there's no bids, whatever, are they dug into that and they have to kind of hold to kind of keep that confidence, and then they're not going to pivot when they need to?
So I think the Fed was definitely slow to raise rates, and exactly as you mentioned, they were probably too dug into their view that inflation would be transitory, and we see Fed officials echoing that, in 2021, and that might have been political in some sense. We saw the Treasury Secretary Janet Yellen last year also say something similar, and maybe those were the talking points. But I want to be fair to them that it was a hard thing to do back then. It's hard to know how the economy would have evolved. The clear policy here, I think, was to keep buying mortgage-backed securities, mortgage-backed securities when the housing market was going up 20% a year. That was clearly crazy. But whether or not to raise rates, that was not the correct call. They should have raised rates earlier. But I think it's understandable if they were a little bit late on that. Whether or not they're making another policy error, I don't know if that it's going to be an error, but I'm pretty sure they're going to try to keep rates high throughout next year. I think it's useful to understand how they're approaching this. So a little bit of history is helpful. So in the 70s and 80s, as we all know, in the U.S. there was very high inflation, over 10%. And what the Fed did back then in the 70s under Arthur Burns was they would hike rates, and then when inflation looked like it was getting under control, they would start cutting rates. And then what would happen? And then the inflation would come roaring back again, and then they would hike again, inflation would come down, they'd cut again, and inflation would go back up. So that kind of stop-go thing that they did back then proved to be not very useful. So they are very keen to avoid that mistake. And Powell mentioned this specifically at his last presser. So he doesn't want to remake the mistake of the 70s. So instead of just hiking rates and then cutting it at the first sign that inflation is coming down or maybe unemployment is ticking up, he's going to hike it to, let's say, 4.5%, and he's going to hold it there for the entire year. That's the game plan that he's trying to tell the market. And I don't know if he'll be able to carry it out, but that's what he's very resolute to tell everyone. Now, something else that I think it's helpful to understand what Powell was doing, to understand Powell, is to think about what happened in December 2018. In December 2018, Powell was also resolute. He told the market that I'm going to be hiking rates in 2019. except that the stock market crumbled, and in 2019, I think maybe February or March, they were indicating to the market that they weren't going to hike rates anymore. In fact, they were going to cut them in the coming months. So he did a complete 180, a pivot. And because he did that in 2018, many people in the markets don't believe that Powell was actually be able to carry out his plan to be Volcker-like. So that's why in the markets you see the market pricing in some probability of a pivot next year. And that, I think, is what the market and the Fed are going to have to resolve in the coming months. Is the market right that Powell is a pivoter? He'll eventually cave and then risk assets go to the moon. Or is Powell right that he is resolute, he is summoned the spirit of Volcker, and he is going to keep rates high throughout next year? I guess we'll find out in the coming months.
I think both of those things can be true. He can be resolute longer than most people think he will and cause more damage and pain than most people expect. But eventually, as you've already kind of made the case, they'll never run out as long as they have the printer. So like, I don't understand. I don't believe any nation, any sovereign would default when they have the ability to print money. You've already kind of made that case.
Exactly.
So both of those can be true. It's the timing of when those things happen.
Yeah.
But back to that just for a second. So Powell came in. He was fired up. He was going to make some change. He was going to normalize the system again, right? He started hiking rates, and to your point, the market dropped, and he was forced to pivot. And it seemed like he pivoted, and again, correct me, but it seemed like, and maybe even hinted to the fact that it was the stock market crashing that caused him to pivot. Whereas this time, it doesn't seem like he cares about the stock market crashing. As a matter of fact, he almost wants the stock market to crash because of crushing demand.
You're exactly right. So the difference is that we have inflation, and inflation is very high. So back then, the Fed's goal was full employment and price stability. Back then, inflation was low. That's okay. So what they were more concerned about was getting the unemployment rate down. So it made sense. Well, if I can cut rates and that will help unemployment and inflation is fine, why don't I just do that? Now today it's completely different. Inflation is very high and unemployment is very low. So we're going to have to get inflation down. So inflation is basically the Fed's primary mandate for the moment. And how do you get inflation down? Well, the way that I think about it is inflation comes down when people can no longer afford higher prices. How do they no longer afford higher prices? When they have less money. Okay, so there's a couple ways you can get people to be poor, so to speak. The one is to make asset prices go lower. Like you mentioned, making the stock market go lower. That means people have less money in their stock account to go spend and buy stuff. If they can't afford higher prices, inflation will come down. Now the other part, which is what I think the Fed is emphasizing more now, is that if you have lower wages. If you have lower wages, then you can't afford stuff. So wage gains, according to the Fed data, it's growing about 6-7% annual rate. Now, if your salary is going up 6-7% a year, obviously you can afford a 6-7% inflation. So in order to get inflation back down towards 2%, you're going to need wage gains of about 2, 3, 4%. And the only way to get that is to have higher unemployment. So that's what they're trying to do right now, basically raise the unemployment. It's not a pretty thing to say, but that is very much the goal. And it's a hard goal too, actually. The labor market is very strong, and it seems we have a shortage of workers. So the Fed is going to have to keep interest rates high until they see the labor market crack.
Yeah, so supply and demand. If there's more open jobs, people will have to work for lower. If there's no available workers, they're going to have to pay them higher. It's simple.
Exactly. Yeah.
Now, I tweeted out something similar to that in the past where it's like, hey, hopefully the people understand the Fed is actively trying to bring their pay down. Like, that's against what the will of the people want. Wages have not kept up with inflation over the last 30 to 40 years. Inflation is raging at whatever you want to believe, 8 or 9% that the CPI tells us, or 15% more likely. And of course, wages aren't keeping up with that. And to your point, they need to bring wages down. That's a problem. The fact that you're getting paid more is a problem for the Fed, and they want to bring that down, which is, I think if most people understand that, they're not going to be happy with that. But you're absolutely right. And then the fact of bringing asset prices down, the wealth effect. So I may not be retiring for 20 or 30 years. I don't plan on selling my house for 20 or 30 years, if ever. But the fact that I see the value of my home and my retirement accounts come down, I just feel more poor. I'm going to not take vacations. I'm not going to go out to dinner as much, et cetera. But I want to jump back to the unemployment part for a minute. So the official unemployment number is low. We're historically low. If you dig into that data, it doesn't look that good to me because let's say for one, the amount of hours has come down, so people are working less hours. Obviously, the job force participation rate is very low, so that's historically low. The amount of hours people are working, the amount of 2 to 3 jobs that people are working, the rate that they're getting paid has come down, which they want that. And then they had this big adjustment in the employment data based off of jobs created and destroyed from last year's data, which was this crazy anomaly. So they added, I forget now, 350,000 jobs or whatever they added. So the data actually doesn't look good to me. Obviously, they have hundreds or thousands of PhDs and analysts looking through this data. I mean, I'm just some guy on YouTube here. So they have to see that, right? But do they just want to run with that headline number because that gives them the cover to run? Or do they see this and they go, well, actually, we're going to use this number, but we see that it's actually not that good beneath. And so our long-term planning is taking that into consideration.
I think they actually do believe the number. So these people who work at the Fed, they are establishment types. They're from the system. They spent their entire life in the system. So they have confidence in the things that the system produces. Inflation numbers, unemployment numbers, to doubt those is to doubt themselves. They're part of the system. So I don't think that they view that as suspect.
Okay. Well,
and I think so there's that, but there's also another aspect as well. The way the Fed gets information, it's not just numbers, but it's also a lot of discussions that they have with other people. So if you are at the Fed, you have connections throughout the business community. So Fed officials will talk to CEOs, talk to managers, talk to everyone really, and they'll have this formal surveys, but also informal conversations, and they want to try to get a sense of what's happening on the street. And what they hear is that they're having trouble hiring people. So when they have that qualitative information that seems to confirm what they see in the data, then I don't think they have any reason to doubt it.
Yeah, that's good to know. Now, let's jump to the topic we've been pushing. So let's talk about the Bank of England. So the Bank of England broke. George Soros famously broke the Bank of England before. Now they broke again. Basically, they couldn't cover the pensions, and they've had to panic and just go all in on the poker table, right? All in, unlimited. Frame that up for us a little bit.
So, at a very high level, it's just supply and demand.
Right.
Supply
It always
and demand
is.
is just the best framework, much better than any big econometric model. It just makes everything back to basics. So, what's the supply? Okay, so 2 things are happening the past couple of weeks. One, Bank of England is gauging a QT, but not just simple QT like the Fed, where they'll let something, let's say the Fed holds a treasury security, gets repaid, and just lets that money disappear. The UK, the Bank of England, wanted to actually sell their portfolio. So that's increasing supply into the market. You're actually selling. The second thing on the supply side is that they have this very aggressive fiscal budget. So I think we've read in the news that the UK government wants to put a ceiling on power, on electricity prices. Well, that money has to come from somewhere, right? So they're going to have to borrow more, and at the same time they're cutting taxes, so they got to borrow even more. So the supply of sovereign debt, which is called a gilt, a UK treasury.
I think it's a $200 billion swing. So it's like a $50 billion tax hit by cutting, and then it's a $150 billion increase in spending to cover the energy bills.
That sounds like not a lot to people in the U.S., but the UK is a smaller country, so that's a huge amount for them. And that's enormous amount of supply, okay? So everyone sees that, there's a lot of supply coming online, we better get out of the way. And so the prices plummet, and that means yields go up significantly. Now the thing is, a lot of people who own those gilts, they own them perhaps on a levered basis, or at least they have, let's say, levered instruments that are tied to the interest rate. So they basically got a huge margin call. Now, it's like any other speculator. You buy something on leverage, or you have levered exposure to something. That something, price changes a lot, then you could be in trouble. And if you look at the interest rates in the UK, well, those interest rates, they shot up a lot rapidly, so they were margin calls. What happens when you have a margin call? You get liquidated by your broker. Okay, so a lot of these investors got liquidated. That means the price goes even lower. That means even more people need to get liquidated. So you had this fire sale like dynamic, similar to what you see in any financial crises. So what happens now? We have a whole bunch of people who are getting liquidated, a lot of people losing money. We have, looks like a fire sale going on. The Bank of England then steps in and offers to be basically the buyer of last resort, similar to what the Fed did during the pandemic. It goes in and it's like, we're going to buy as many of these gilts as we need to buy. And once the Bank of England steps in and it's willing to buy as much as needed, and the Bank of England has unlimited amount of money, then the market stabilized. And we can see this not just what's happening in the gilt market, but in the treasury market as well. When the Bank of England stepped in, those long-dated UK gilts, they basically, the yields just kind of plummeted enormously, like the biggest drop in the history of gilts. And that pulled all the other sovereign bond yields in the world down as well. So you saw the treasury yields, I think, go down 30 basis points. So it had a global effect of calming the sovereign debt market.
And is that because they're like, well, shoot, if the Bank of England decided to bail out their market, then everybody else will as well? So that was kind of like that reassurance?
I think that's definitely some aspect to it. If you have one sovereign, so the global bond market is tightly connected because it's all credit risk free. So that means that, so if I'm an investor and I can get, let's say, 3% in the UK or 4% in the US, and after hedging currency, I'm going to go with whatever is higher because they're both credit risk free, and so that's fine. So they're all connected together. If we see the UK gilts come down, then mechanically everything has to be priced with some some relative value relative to the gilts. So that side, and also of course having a central bank come out and being willing to do QE or print money, that always makes the market happy. So, and that does increase the probability that maybe the Fed or someone else will be doing the same thing in case something became too disorderly. And if you look at the commentary, a lot of people are looking at this as a potential pivot point, which it definitely is not, but the market is always hopeful for things like that.
Yeah. So now I think they pledged unlimited QE to support the bonds up until October 14th. So
exactly.
Just for like this period. So
yes.
Then we'll wait and see, right? If they've restored enough trust and then they can stabilize the yields and more people want to buy them, they can bring buyers back in, then maybe they stop. But if no buyers come back in and the yields start spiking again, they're going to have to probably jump back in again.
Exactly. And that's the problem, not just the UK, but all the governments in the Western world. They've borrowed so much that the amount of debt is so huge that the market can't function anymore. The supply is just enormous. So in the past, the problem was hidden because you had people, the central banks buying it, Fed buying it, Bank of England buying it, ECB buying it. So you don't really know what the real appetite is for sovereign debt, and apparently it's not a lot, at least at these prices.
Yeah, we can see that for sure. Now, you said the word credit risk free, and we
Yes.
mentioned that earlier, risk free returns, and so credit risk free. So government bonds, specifically sovereign bonds, specifically. Probably tier one nation sovereign bonds are considered risk-free. I don't know if you would consider, the El Salvador bond or the Turkish bond risk-free necessarily, right? And before you answer that, they're considered risk-free because to the point that we're both agreeing on, no nation would default on their bonds when they can print the money, and so they're considered risk-free because they're always going to be able to pay that.
No, that's exactly right. If you have a printer, you can always have the ability to repay your debt. but you could voluntarily default. And that's the reason why that the U.S. actually does not have a AAA rating from the S&P. The S&P saw that the U.S. During we have periodic debt ceiling episodes where one party doesn't want to raise the debt ceiling. The S&P Standard & Poor's, the rating agency, saw that the U.S. maybe would voluntarily default during a debt ceiling episode, and because of that, they cannot be AAA. But they have the capacity because they have the printer, but sometimes they may not have the political willingness, as you suggested.
Yeah, well, and then they run into limitations, and so it's the proverbial rock in a hard place. They can print as much as they want, just like Zimbabwe, but then you have runaway inflation. If you don't print,
Yes.
you default. If you do print, you have inflation, and so which one is worse, right? Which one do you have the political will to deal with? Are you okay
Yes.
seeing everybody's pensions wiped out and everybody broke on the street, or would you rather people just pay a little bit more money for the things they buy?
Yeah. So it's a political. It's always so. Inflation, in my view, is always political. So how do you create inflation? Just give everyone $1 million. Everyone has $1 million in their bank account, you have a lot of inflation.
Yeah.
How do you create deflation? Let's say raise taxes to 90%. Take everyone's money away. Hike interest rates to 100%. Make the stock market go to zero. So inflation is ultimately, in my view, a political choice.
Now, I would imagine other pension funds are doing the same thing that they were doing in the UK. And as we see, so I guess there's three, I guess maybe the top three central banks in the world, the Fed, the BOE, and the BOJ, when looking at, currency, liquidity around the world or amount of payments or whatever. I would imagine all three of them are probably doing the same thing. The BOJ and the BOE coming under massive pressure in their markets, and so could we see a similar situation arise in in Japan?
In Japan, so
Or they don't really have
flattering
the pension situation like we do.
You're flattering the Bank of England. 100 years ago, during the British Empire, now it's the ECB is the second largest. ECB and the Bank.
BOE. Yeah, you're right. I think is the fifth, right?
Yeah,
Sorry, you're right.
they used to be important. They probably wish they still were. So the Japan is different because Japan is doing something called yield curve control, which is basically fixing the price of their sovereign debt. So because the price is fixed, they cannot. The pensions are fine. They can't have any suffer the same problem. But in Europe, they definitely can, and I think that's the next point of weakness. So Robin Brooks on Twitter has a very, very good graph of who has been buying Spanish and Italian sovereign debt over the past few years. It's the ECB. The ECB has been buying it all.
Of course.
Now, if the ECB steps back, you can have the exact same thing happen where the yields shoot up very high, and that creates losses for the people who are invested in those. And the people who invest in Spanish and Italian debt, they're the banks, pension funds, and so forth. So you could have something similar happen, which is concerning, but likely can also be fixed. The ECB will just go and buy more, and that will be negative for the euro. So that's probably the next weak point as we see QT unfold globally.
Now, we've set up a big problem that seems to only be getting worse. Governments are going to spend more money than they have. Deficits, tax receipts might go down. Deficits will probably go up. They'll have to continue to print more money. At some point, this kind of comes to a head. We're starting to see some big cracks showing up, obviously, in Japan, and now in Europe has bigger cracks. We haven't really talked about Europe, but the ECB's got their problems with the pigs nations down below, Portugal, Italy, Greece, Spain. Obviously, the whole Russia situation. We're seeing it, the first crack really with the Bank of England, but it's like that first crack, they all start coming. I want to kind of talk about this end game, maybe, hypothetical situations. But before we do, let's jump to another topic, which is central bank digital currencies. So obviously China rushed their central bank digital currency through. They unveiled it at the Olympics that they had there in China. Under President Biden, through executive order, they've been rushing this CBDC through. The Fed now released this FedNow thing. It looks like this central bank digital currency is rushing through. What are your thoughts on that? What are you hearing on that?
So I think a CBDC is not. There's really no use case for the U.S. So CBDC, if you look at who's really gung-ho about CBDCs in the world, it's like you mentioned, it's China. It's these totalitarian states because a CBDC is ultimately a surveillance tool. It's a way to control people. If the government can see whatever you own, and maybe they can lock your account, maybe they can make sure that you just do what you're told. So it's what totalitarian states really like. Now, here in the US, whether or not we have a CBDC is ultimately a political choice, and you'll hear different things depending on who you speak with. Powell actually seems to be slow walking the CBDC project at the Fed. He says that we need to do more research on this, and we need regulation and so forth, and we need Congress to pass legislation showing that there's a clear intent. So I think that the Fed, so Powell wasn't the only Fed official who seems to be not too warm about the CBDC here. Another one would be former Governor Quarles, very clear that we don't need a CBDC here, and they're all right. Why there's really no use case in the U.S. It seems to be more of a potentially dangerous political tool. So at the moment, the people in charge of the Fed don't seem to want to go down that path. I think there are voices in the Fed that are influential who would be happy to see a CBDC. For example, Leo Brainerd, who is also a member of the World Economic Forum.
Yeah.
As you guys know, the world countries that are under the influence of the World Economic Forum, like CBDCs, like the Eurozone, like Canada, and so forth. And it's I think it's very much so I can't see a real economic use case for it. So I think of it more as a political tool to have better control over a country's citizens.
Well, what about as an economic tool? So the problem in the 2020 pandemic was they sent all the stimmy out, and they were hoping to stimulate the markets, but then people sat on the money. They didn't stimulate the markets, or they put it into Robinhood as opposed to buying goods and services. And so if they have the CBDC, which we started seeing that language come out in some of these stimmy bills that came out in 2020, maybe it's a tool where they could inject liquidity directly into the market, and they could affect that, how fast people spend it to make sure it does get spent, and even into the right places. So it could be an economic tool. That's obviously control, but control for economic purposes.
Yes, it's control, and it can be exercised in positive ways or in negative ways. In the exact same way, we could say that, hey, you're protesting where you shouldn't be, or maybe you voted for the wrong person. You know what? Maybe you shouldn't be spending any money at all. So it's an extra tool, and like any tool, it depends on how much confidence you have in the people who make the rules or people who actually wield that tool. And it can definitely be used for very positive purposes, like getting money directly to people. But under the wrong hands, it could also be used to silence dissent or punish your enemies. So ultimately, it depends on how much confidence you have in the system. Now, in the US, we have a tradition where we don't have confidence in the system. That's why we want the system to be as weak and small as possible, because we know that if you give people, regular people, a lot of power, they are tempted to use that for their own benefit.
Yeah.
So that's so again, that seems to be what history portends. So
in your guess, you would think that maybe, if I'm reading you right, that maybe we might see it in other nations first, and maybe the U.S. might be one of the last to adopt it because they don't have a big economic need. It's more of a political tool, and the people would probably kind of push back with the checks and balances that we have.
Exactly, I think that's right. It completely depends on politics. This is completely a political choice. The political leadership we have now at the Fed does not appear to be think that the CBDC is very important. If maybe we have a different Fed chair, we could get a different outcome. So at the moment, it seems like the U.S. will be probably one of the definitely not the first country to have something like this.
Okay, so now let's take the situation that we have, and let's just hypothetically kind of game plan this out. So it seems like I think you have the whatever the Peter Schiffs or whatever that have been calling for this system to end. The Mike Maloney has been calling for it to end for 10, 20 years. And I think they're right. I mean, factually, like this doesn't work over the long term, but like how long can it go for? Like we don't know, right? They seem to have more tools up their sleeve than most people had thought. But we're starting to see serious cracks with the Bank of England. And to your point, they're not one of the top banks; they're one of the smaller ones. But Bank of Japan has their big problems. The ECB's got massive problems. The the Fed has opened up swap lines with these central banks to basically bring them on their back and provide this liquidity to them. And so kind of Brent Johnson's dollar milkshake theory, maybe the dollar just continues to rise stronger as it continues to bail these out. But eventually the same constraints are going to hit everybody at different times, which is, one, do we continue to just print this money and rage inflation, or do we let the whole system crash? I mean, it does it keep going for a while, as right now we're seeing the Lebanons and the Turkeys go down, but eventually we see the Bank of England's and the Japans go down, and then the ECB, and then finally the dollar is the last one standing, but then they're still stuck with the same constraints. Is that kind of how you see this playing out over a period of time?
So I think that, currency and so this is ultimately a question of confidence. So what we see right now, what's happening is that globally, people still have the most confidence in the U.S. Right. And if you have problems in the Eurozone, if you just look at, the euro is depreciating a lot, that means a lot of people are moving money from Europe to here, and similar in Japan. And similar to many other countries, it's you go to where you feel it's the safest. And U.S. here, we have positive interest rates. We are secure, food secure, energy secure. There's no war nearby. So if there's unrest in the world, the U.S. is going to be the ultimate beneficiary. I think we see this now. I expect this to continue. So continued strengthening of the dollar, that sounds reasonable to me. But as we've been discussing, the U.S. is not has its problems as well. Ultimately, we will not be able to keep printing and spending forever. But there's a sequence to this. First, the weaker countries, the periphery, they have their problems. They fall. Money comes to the U.S., concentrates, but eventually money is going to have to go somewhere else as well, because the U.S. has its own problems. So what it could happen is that it can just go into things like real estate, or commodities, things like that, things that cannot be printed. Because if the question is ultimately that the people who manage our currency system, the government, is not doing a good job, then you want to go to items or things where the government cannot mismanage, and that those are more tangible things like real estate and gold, maybe even, and maybe crypto as well.
Yeah, Bloomberg Intelligence put out a piece of work that they said that they think they could see Bitcoin transition from a risk-on to a risk-off asset by end of 2022. So that could be interesting. I've often said that Wall Street trades Bitcoin like a risk-on asset, but it's not a risk-on asset. And so there's like this mismatch in perception and reality. So it's trading like a risk-on asset, particularly because of Wall Street, has taken such a big chunk in it, and the market's small. But what we're seeing in about 4 billion people in the world living under totalitarian regimes with triple-digit or double-digit inflation, they're using Bitcoin to get out of confiscation, high levels of inflation. I covered it yesterday on the radio. Sub-Saharan Africa is the largest place of adoption happening. If you look at transactions under $1,000, like 80% of them are happening there. And so you go where the pain is the highest. And so at some point that reality flip-flops, right? So it'll be interesting to see how that happens. So that sequence that you talk about, weaker countries falling first, money moving to the stronger ones, to the USD, then eventually, though, the USD is going to have the same problem, and then people will find other outlets for that. And so whether that's real estate, which has been a traditional one, or stocks, gold, Bitcoin, et cetera. Timing. So you have the Harry Dents out there, plenty of other people. Jeremy Grantham, we're in a textbook bear market bounce. We have a 50% drop in front of us, et cetera. But then there's other people that say, no, the market structure's holding up. The Fed's kind of has things going. Money's coming to the U.S. because the markets are worse. And maybe we'll just kind of continue and muddle kind of along. Which camp do you find yourself in? Obviously without a crystal ball.
Yeah, I don't really So I don't think we have a crash in mind. So and I'll tell you why. So just like the framework that we were discussing, the periphery falls first and money goes to the center. We see the UK falling, right? So they come out with this. Okay, so their bond market goes crazy and their currency depreciates. That means a lot of people are taking money out. They don't have confidence. Well, they don't like the outlook in the UK, or maybe they find the US more attractive, and they're putting money here. Now, I was actually just having this conversation with a foreign-based investor. Suppose you are a UK-based investor and you invest in the Nasdaq. Okay, year to date, you would have lost a lot of money, right? The Nasdaq went down. However, when you look at it in pound terms, you're not really down that much. Maybe you're even flat,
Right.
because even though the Nasdaq is going down, you invested in dollars, and so in local currency, as the dollar appreciates, you're earning that in pounds. And the same thing in Japan, for example. You can see the Japanese currency basically went from 100 to 140, right? Almost 30-40% depreciation. So if you're a Japanese investor and you invest in U.S. stocks, sure, the stock market went down, but the dollar appreciated a lot. So in yen terms, your account looks more or less the same. Now, this is going to happen to a lot of the foreign investors. So they're going to want to put money in the US, because even if the US stock market goes down more, they're going to earn money from the FX appreciation. The dollar's going to go up. So they're not really they're going to be buffered from the losses in the stock market. That kind of puts support in the US. So much foreign money going in and just buying US assets. If that's the case, I think it's hard to have a crash. You just have a lot of foreign money pouring in,
Yeah.
making money off the currency, the dollar appreciation.
It's a good point. It's a good point. We talk about money increasing and money decreasing, and the booms and busts. And so, while maybe the Fed is decreasing the money supply now, we're also increasing it because we're attracting all this international capital at the same time. Is kind of what you're saying.
Absolutely.
And then supply and demand. Are we going to have more capital coming in than the rate that the Fed is decreasing it by? It's a similar thing as I was just talking about with Bitcoin taking adoption in sub-Saharan Africa or Lebanon, where you have to break into the bank to even just get your own money. They're literally robbing banks to get their own money out. And so you're like, well, shoot, I guess I'll just take Bitcoin. I mean, it's down 65%, but that's better than losing all of it, kind of a thing. But to the
you lose. I'm sure the Bitcoin is like, if you in local currency terms, Bitcoin, they're not losing anything,
Right.
because they're probably gaining.
Yeah. That's a really good point. Man, I think that's good. I think we've covered a lot of ground. I appreciate you giving us that last bit of insight. You don't think there's a crash, and you told us why, so I appreciate that. Man, you've been a wealth of knowledge. I appreciate that. So I know you're pretty active on Twitter at FedGuy12. We're going to make sure we link down to that below. You also have a website, fedguy.com.
Yep. Yep.
Anything else that you want to draw attention to?
I know many of their audience are interested in monetary policy and the financial system. I also have this book. It's called Central Banking 101. It teaches you about how the Fed works, what the international dollar system is like, and a lot of the mechanics of the financial system. So if you guys are interested, check it out. It's on Amazon. It's very well reviewed.
You got 400 ratings there.
Yeah, it's almost 5 stars. So I think it's something that would be helpful to your audience if they're interested in the financial system. Yeah,
I love that you have the money printer on top, and you use the word money printing, which we all use. It's obviously we all know that's not how it works, but that's the common language. I'm going to make sure we link to that Amazon description down below, and I'm going to buy it as soon as we get off of this call as well. Leave you a review on that. With that, Joseph, I guess we'll go ahead and end it.
Yeah, thanks so much for inviting me. It was a pleasure, Mark.
Thanks, Joseph. All right, that's a wrap. Thanks for listening. Hopefully you got as much good information out of this conversation as I did. It's always great to get a different viewpoint, and more specifically, somebody who has intricate knowledge of the inner workings of the financial system, and specifically the Federal Reserve, the central bank. And so it was a great conversation. Hopefully you enjoyed it. Check out the links in the description. Follow him, buy his book, follow him on Twitter. Of course, like this video if you liked it. Thumbs down if you didn't, that's okay. But at least leave a comment and tell us why. Hit that subscribe button while you're at it. And that's what I got. To your success. I'm out.